Dimitri Pargamonic. How you doing, Dima?
Pretty good. How are you all?
Good. And this is a webinar with one of the great chameleons out there, the Dr. Jake Kilby, all the way from middle of Asia, Malaysia. And he runs a Discord group that he created. A lot of it revolves around the chameleons, some doesn't. But Jake is one of the great resources that we've come across when thinking about trading and using different products out in the marketplace. And thanks for joining us tonight, Jake. Jake, you're on mute.
Hey there, guys. Yeah, hey there, guys. I'm here now. Thanks very much. And thanks for that, Will and Dimitri, and greetings to all the chameleons across the planet. So I guess today what we're going to do in today's session, three things. We're going to have a look at a quick trade using the chameleon, the front page on the chameleon. We're going to revisit the SPY position that we had and is going to expire actually today. And then we're going to look at another option strategy, which is a protective put. We're going to do that with an energy ETF. So without further ado, let me share
Jake,
my
screen. Before we get started, sorry for interrupting. I forgot to run right into the disclaimer. So let's get that really quick and then we'll get started. You want to do that, D?
Yeah. And hi, everyone. Before we get started, keep in mind, Will and I and Jake, Market Chameleon, we're not registered investment advisors or broker dealers. We're not telling you what to do. We're just sharing our ideas. If you need professional help, call your broker. That's what they're there for, to help answer your questions and provide you with guidance. There's the disclaimer. And now I think we could hand it off to you.
Yeah, let's get started with the first call, Jake. Here you go.
Okay, so here's my screen. Let's get it up and running. So yeah, so I guess hopefully you guys can see the front page here of the Market Chameleon, right? So normally when you'll actually log on to Market Chameleon, you'll now see a range of positions with a yield and days to expiry. And very quickly, so I'm going to just take one with maybe 14, 20 days to expiry. Let's just take the top one and just walk through it relatively quickly, and then we'll comment on it and go through it as the weeks progress, so to speak. So here we're looking at Nvidia, which is a technology firm working on chipsets and the like, and etc. And essentially here a bull put spread. So what we're doing is selling an 800 put and buying a 795 for a $1.90 credit, which you can see here. So max loss is $3.10 on the position. So what I'm going to do is I'll just show you how we'd actually put that on. Bear with me. So this here is TWS from Interactive Brokers. I mean, you can see we've got the SPY position there. So I'm just going to very quickly click on Nvidia. So we're at $814. So if we go back here, so we're slightly below where the position's at now, right? So this will actually expire, hopefully, out of the money effectively, if the stock price stays at this level or rises. So if you go onto the options trading part, we're looking at 795, 800, and we're looking at the July 16 strike. So let's just go 14 days out. I just click up here, you can see here, and we were looking at it was the 795. So sell the 795. Sorry, it's the 800, wasn't it? Sorry, sell the 800 and buy. Let me just recorrect that. Sell the 800 and buy the 795. And if you look here on the screen, so we've got it down here, sell one contract 800, and it shows you the deltas, right? It shows you theta as well. So you've got a positive delta when you're selling a put, even though you don't see it here, you're selling. So a negative by a negative is a positive. And then you've got a negative delta. So here, if you add the two together, and this is what I'm going to speak a little bit about later, which is directional risk, you've got the equivalent of a position which moves like 3 shares. So the spreads are quite right. I'm just going to put this on mid-range, and we're just going to try and get it filled. And we're going to see how that goes. It's a very small position, but that doesn't matter. We're just going to see how it goes over the next 14 days. So let's put that on and see if we get a fill. My orders are there. It's just about. So I'm just going to leave that for the minute, and we'll come back and visit if it hasn't filled in a little while. But let's just keep going on and start off revisiting what we did. So this is a bit of a recap, right? So last week, I think you guys remembered Delta, right? And that's one of the things I really wanted to speak about, and just, I think it's really important for everyone to get an understanding of directional risk, right? And this is one of the first order Greeks, and it expresses a change in value of an option for a $1 move in the underlying, right? So deltas can move from -1, which is perfect negative correlation, theoretically speaking, to positive one, which is perfect positive correlation. So as a position, as a call or a put moves further into the money, its delta it'll converge towards 1, and it'll start actually behaving like the underlying, right? And oppositely speaking, if the option is out of the money, it will actually converge towards 0 over time, and it'll move slower and slower, and obviously not like the underlying at all. And one thing here is quite important as well is delta can be 0, which means you're effectively perfectly hedged, whereby the underlying will move, let's say, make $50, and your option position will make minus $50, and you'll be perfectly hedged. That's what a lot of broker dealers do. And as I mentioned last week, so delta for long calls is positive, and for long puts, it's negative. And then at the money, and we saw this, and if we just dive back here into the options bit here, and we look at the money, so we can see here on the system, we're about 0.5. And you see here 0.5 and 0.49. So at the money is effectively about 0.5, as mentioned earlier. So delta 1, this is another thing that's like more for your info than anything else. Quite commonplace in equity derivatives and investment banks and so forth. And a famous Delta 1 desk was the Societe Generale Delta 1 desk, where Jerome Kerviel, who was actually a Eurostoxx trader, developed his trade. Actually, the bank almost went bust. I think he lost about 4 or 5 billion euros at the time. And these guys really are the true derivative commander. So I think it's really important, more than anything, to understand the aggregate exposure or the directional exposure to the basket of securities which you're holding, right? So next time anyone speaks to you about COVID, like, forget that. It's not delta and alpha and whatever. The real delta is the directional risk on the basket of portfolios that you hold. So here, this is like a 2x2, and it's something, particularly for the newbies. For me, I had a little cardboard cutout piece of paper, and I was carrying this around for, maybe 6 months, a year, just to familiarize myself with how positions worked, essentially. So I've got here, and we spoke about this last week, when you're a buyer of a contract or 100 shares, you are long delta. When you're a seller, you are short. You're short deltas, right? So when you buy an at-the-money call, you're buying one contract or 100 shares by 0.5, you've got exposure of 50 deltas. And when you buy a put, the opposite can be true. See the negative sign here, you've got delta exposure or directional exposure of negative 50 deltas. Now, what does that mean? That effectively means that as the stock price goes up, you will be effectively making half those gains, 0.5 of those gains. And here, the opposite is the case. So as the stock price goes down, this gains in value. And the opposite can be said on the short side. So when you sell, and this is what we did with the covered call, right? We sold an at-the-money call. So we sold one contract by 0.5 delta. So we had underlying exposure of negative 50 deltas. Capping off, you guys remember the payoff diagram, right? We had the equity position like this, and we sold that call up here, and we were capping off any potential future gains we had. And then the big watch the mountains moment, right, is when you have a negative multiplied by a negative, and it can kind of be confusing. And these are the famous short puts, which are quite dangerous, and I don't recommend them for people who are starting off because of the risk. But effectively selling a short put or selling a put, you've actually got positive exposure, right? And you have a limited gain, and that's the value of the put, the price at which you sell the put, but you have effectively unlimited exposure, okay? So, and it looks kind of, as you can see on the payoff diagrams there, looks kind of like a call option. So really important, and I guess I'm showing my age here with a little bit of a picture from Top Gun, but when you look at your basket of portfolio or your basket of securities, sorry, just make sure you watch the deltas, understand the directional risk in the portfolio that you're holding, okay? So covered call, very briefly, building block of any options trader's basic education. Generate income, as we saw last week, on holdings while sacrificing that upside potential. Smaller risk, arguably. Short option is covered by a long equity position. Now, if you sold that call without owning the underlying, you're selling effectively a naked call and putting yourself at monumental risk, because if you have a massive upside, or you have, for example, a takeover, you're selling a naked call on a security and there's a takeover and the security goes up 30-40%, you can get blown out of the water. This is unlimited risk and very dangerous. So hence the importance of that call being covered. And so essentially what it does is it reduces average cost purchase of stock, gives you a bit of a regular income stream if you're good at managing covered calls, and ideal for mildly to neutral or mildly bearish markets. Okay, so excuse me, we saw this before. So this is our payoff diagram, and just remember the recap here. This bit here is a negative, so these are cash outflows or losses. This is a positive here, so this is cash inflows or profits. And as you can see here, this is our equity position, right? So as the price increases this way, the value of our equity position increases. Okay, and with us, what we did, and let's just have a quick look at it. Going back onto TWS, remember this guy? So we bought 100 shares of SPY, and then we sold immediately and at the money 419 call, which is deep in the money now. Okay, so what happened here was we bought those 100 shares of SPY, which is the S&P 500 ETF. We had a cash outflow of about $42,000. When we sold the 419 call, we sold and we gained a cash inflow, a premium, right? So this is when you sell a call, you're selling, for example, at this kind of level, and this is the cash inflow level at which you're selling that call. So what we're doing effectively by doing that is we're reducing the average cost of those 100 shares of SPY. And what happens is guys who are actually quite good at managing covered call positions, they can on a weekly or a monthly basis, so this time we made like $400, right? So maybe next week or next 2 weeks, we can make $60 or whatever. And as the year goes on, that kind of compounds and that reduces the cost of that ETF that you bought. So it is kind of interesting. It's tricky to do, but it is, it's kind of a good strategy to get your teeth stuck into. Now, for me, one of the drop sides, so I wouldn't normally sell a covered call like this. I'd actually use a synthetic and sell a call on top of that, but that's kind of for another episode. And here we've got this top side, right? So this is the call we sell at this price here. So that's plus $400 on this side. Now note, let's just have a look at TWS. Now SPY has blown through the roof, right? So I think we're at $430, right? So if I had never sold that call, I would have actually made more money, right? So basically the stock has gone now, excuse, this is not 100, but let's just say this is like 430 kind of over, sorry, 430 kind of over here. I've lost a potential gain theoretically, okay? But I've guaranteed, or I've locked in a gain by selling that call. So now we've got our kind of Mr. Miyagi moment, right? So what are we going to do? Are we going to, if we just look back on TWS, this call, as you can see here, it expires today. And because it's deep in the money, what that effectively means is at the end of today's trading session, I will have the obligation, because I'm a seller of an option, I'll have the obligation to sell 100 shares of SPY at $419. So we can do a few things here. And let's just flick back to the spreadsheet, the presentation. We can roll or not to roll, right? And that's really the question. If we don't roll, we're going to allow assignment of the stock, and we will have potentially a capital gain event. Now that may have implications, not in the US or wherever, in terms of capital gains tax and so forth. So you need to consider that if you let something get called away from you, where you're forced to sell it at a profit, you may make a capital gain and therefore be liable for the tax. So really important thing to note as well. Or what we could do is we could roll it. Now what I'm going to do today is I'm going to roll it, and not because it's going to make me a millionaire rolling SPY options at that level. I just want to show you guys how to do it, rolling for a credit, and then maybe in 2 weeks' time, we just let it get assigned, see how we go. But the things we need to look out for is, do we need the cash, right? If we needed those $40,000, let it get assigned, right, to have a cash inflow. What's our outlook for the underlying? So SPY, what do we think, guys? I'm kind of bullish, mildly, bullish to neutral. I'm definitely not mega bearish, that's for sure. And then what kind of credit can we take away? Now here, the credit's not big at all, but let's have a look. So flicking over, and we'll look at so we've got the call here. on the IB, on the TWS platform, it's pretty easy. You just do a right click on the option, and you see here on my cursor, you hit the roll button, and basically you just get the option panel up there. So we've got 419. So I'm just going to roll it out for another 2 weeks at 419. See if I can get a credit. So let's have a look. So here we go. So look, it's nothing, right? In between the spreads, it's $6, $7. So in theory, it's not really even worth doing, but it's more about showing you guys how to roll something. When you roll something, roll for a credit, never a debit, right? So let's just go for $7 and just try and get filled, right? So just transmit that. And my Nvidia spread has not been filled, has it? And I don't know why, but they just don't seem to want to fill that, but we'll just see how we go. Let's have a look. What's this being monitored? Okay, transmitted and accepted. We're just going to see how that goes. If it doesn't get filled during the session, then I'll just make sure it gets filled later on during the day. So let's just keep going, and we're just going to flick off and erase all the ink. And this is what we have in MarketChameleon, right? And you guys are familiar with this. This is our payoff diagram, and this is the covered call. Now, things which are really cool to look out for. So this is our maximum gain here, right? We can't go beyond here because the underlying will be called away from us. These are really important things to look at MarketChameleon. So you look at, how much credit you're taking in. So here, this point here, come all the way across here, it's about $150, as we can see, for one contract, of course, or $152 for MarketChameleon. Now here, we mentioned the famous delta, right? And this is what I want you guys to familiarize yourself with. If we just had equity, 100 shares of SPY, we'd have 100 deltas, right? But when we sell the call, we take on negative 50 deltas. So our net position now is going to be positive 50 deltas or thereabouts. And that's what you can kind of see here. Now these Greeks, and we're going to go through them as the weeks progress and stuff, but it's kind of complicated to figure out all these Greek names. So the way I do it is I try and put it in English. So with delta, I think directional risk. Gamma, I think gearing. Vega, I think volatility. Theta, I think time. And rho, I think rates, right? And so we're going to go through them individually as and when we continue. But on the Chameleon here, the payoff diagram is great. I'm always looking at this. So when I set up a position, I have a look at the payoff diagram and I look at that directional exposure and that risk. Okay, so now we're going to go on to the last thing for today's session, and that is a protective put. So we've learned covered calls. The next thing we're going to do is a protective put. Now, what I would normally do is I'd trade futures contracts when I want exposure to global energy, but we thought that maybe going into futures right now is maybe a bit too complicated. So we're just going to use an ETF, which is relatively representative of global energy, which is the XLE. And I'm no chartist, as all I've got here is just to show you guys just a chart of XLE over the last 20 years. And what we can identify is a bit of a boom phase into the back ends of 2010, where I think we had oil at about 130, 140 bucks, a bit of a bust phase. And this part here, for you guys, particularly GOAT out there in Texas, you probably remember, is the famous shale boom in the United States, right? Where we had the advent of a lot of technological developments around tight oil, unconventional formations and the like. And the US actually brought up its oil production to beyond 10 million barrels a day. So that was kind of a real advance in technology, which pushed oil prices again up much further. Then we had another bust period kind of here. I think CL, the barrel, this isn't obviously a graph of the barrel, but CL, which is the barrel of West Texas Intermediate, I think went down to about $30 in, I think it was January 2016. And the big one that you guys see here is the COVID bust, right? When we had the shuttering of the world economy, the shuttering of industry, transport and the like, and had a massive impact. And from then onwards, XLE, which has kind of been the unloved child, not the unloved child, but definitely the energy stocks from last year have been the unloved children, have seen a real boom into 2021. So let me just scrub off where's my pen? Sorry, let me just scrub off this. So what we have here, and sorry, stand by, bear with me. What we have, let me just try to get yeah, there we go. That's cool. Excuse me. So what we have on the Chameleon, which is really cool, is you go onto the ETF on the right-hand column, you can actually go and see what the underlying is on the ETF. So when you actually take a position in an ETF like this, you've essentially got exposure to all these stocks, right? Normally big mega cap US oil players, which cover the full spectrum of the energy industry. And what I mean by that is they do upstream, midstream, and downstream. So upstream, exploration and production, the midstream part, and then the downstream, which is refining and stuff like that. And you can see over the year, they've really boomed effectively. But you know, back last year, they were the underperformers of all the asset classes. So yeah, something really, really interesting. So what I've got here is our famous payoff diagram again. And for the aficionados, I got a little historical picture of Spindletop, which is, I think that's 1930s Texas. Real important moment in history for the development of drilling systems, particularly using mud. And then I've got here, I think this is a 5th or 6th generation semi-sub. I think that one's Brazilian, deep water offshore. It's where the big boys play, right? So I'm talking offshore pre-salt Brazil or even Gulf of Mexico, big depths, between 0 to 2,000 meters in depth. And these things can drill basically downwards of 10 kilometers. So pretty impressive units. And, back in the day when we're talking about, $140 oil, for people who are interested in the energy stocks and particularly the drillers, these things had day rates of maybe between $750,000, $650,000 a day. Obviously, oil tanked. We went down all the way down to, $200,000, $300,000 a day, but big capital equipment. So when you invest in things like Noble Energy or Seadrill or any of these kind of stocks, just understand that you're investing in stocks which have mega leverage and they've got mega capex on their books. So let's have a look at our protective put. Let me just get rid of this ink, and we're just going to flick down. So we're going to use the ETF XLE. And what I'm going to do is I'm going to take probably 1% of my portfolio. I'm thinking $10,000, just simplistically, because I don't want to have to buy so much of the ETF, the underlying. And what a protective put is, it is where we will buy long put options to protect ourselves, right? Then we'll buy the underlying, which is going to be XLE, and we're just going to let it fly. So what I'm going to do, and you're going to see on TWS, is I'm going to buy the put options out probably till December. I'm going to buy the equivalent for the ETF, and then we're going to manage this actively as the weeks go on. So what I'm probably going to do is I'm probably going to sell calls against it as well as the weeks go on, just to try and lower that average cost of ownership for the ETF. So these numbers may not be correct. We're just going to have a flick. Let's have a look at the system right now. Let's just go on right now. So this is SPY, and I still haven't been filled on either of those, but that doesn't matter. We'll sort that out afterwards. So XLE is, so we're down 54 bucks, down 1%. That's okay. I'm happy to buy on the dip. Let's have a look at the options. So what we have here, as I mentioned to you guys before, calls on the left-hand side, puts on the right-hand side. What we want to be doing is buying puts. And I want to buy about $10,000 worth of puts, which is about 1% of the value of my total portfolio. So here we would, I'm just going to go mid-range. Let's see, maybe 20 contracts. Let's have a look. Set it up. Let's see, 473. What does that give us? So we're a little less, right? So 2,000 shares, 9,460 bucks. I'm okay with that. So I'm going to try and get that filled. And then immediately thereafter, I'm going to buy 2,000 shares of XLE. And what we're going to do is we're going to let that run, and then we're going to manage that position actively. So let's just do that. And hopefully I get a fill. So I haven't had one fill yet. Okay, and I'm going to leave that on. If I don't get a fill during this session, I'll make sure it gets filled later on. Okay.
Hey Jake, you have a sec for a question as you're
Certainly
waiting
do.
for that fill. One of the chameleons on YouTube was asking, how do you decide 1% of your portfolio?
Okay, normally so risk management, right? When you manage a basket of securities, it's more about understanding what you can lose more than what you can make, right? And a lot of people who start off make the mistake of thinking about, well, look, this is what I can make. And they never think about what you can lose. It's just a game of probabilities. Normally what I would do is 2% max. It varies between 1% and 2%. 2% max value of the portfolio from a risk management perspective. Now, specifically here for XLE, the reason I've only chosen 1% is because I don't want to have to, if I bought, so $20,000 on the puts, I would effectively have to buy maybe, 200,000, 100, I would have to immobilize maybe $200,000 of $1 million in underlying, and I don't want to do that. What I'd normally do is I'd use a synthetic, but I'm not going to do that today. So 1% works for me, but yeah, 2% max as a rule of thumb. And the first thing I recommend all you guys do, and I remember doing this when I started out on a pen and paper, and I used to draw out my payout diagrams by hand, and understand what you can lose first of all. Forget about, the profits will take care of themselves, but just have a look at what's my max loss. And once you figure that out, the rest kind of takes care of itself.
All right. And I was gonna just, if I could, chime in really
Sure.
quickly, because I do get, talking to some customers who, they'll come in and almost like in the week's time, they're so eager, to do a trade and make money, and they think like this is going to go up and I'm going to make. So I'll get some people will say like, well, look, Dimitri, I came in, I had $10,000 in my account, I bought $8,000 worth of a call in Amazon, but Amazon went down, so now I can't trade until it goes back up because my call is like already down 50%. And I'm like, well, so it's important, that aspect of it, how much you're risking on an individual trade is extremely important to the long-term success, because if you do that, that's not really trading. That's very speculative, right? You're just taking a shot at that point, because no matter what, there's uncertainties. Even if you do the best research you could possibly do, it's still uncertainties. And, even if if you do that, and Amazon doesn't even have to go down. If it doesn't move, your call option could decay, implied volatility could go down, and then you're done. So everybody, in the industry, there's no professional that would do something like that, take their entire portfolio, or even like a huge portion of the portfolio, even 50% of your portfolio, and put it all into a single trade, because that's already, you're really at that point just taking shots. You're just trying to buy lottery. So you shouldn't expect huge, to be.
Harry Markowitz and modern portfolio theory, it's all about diversification and risk management, right? So I think a lot of people make the mistake when they start out thinking, because there's a lot of hype in the media and stuff, and we always speak and we always kind of glorify the guy who made, 20,000, 100,000, $1 million, or whatever it may be, selling, not selling, buying YOLOs or buying calls on some like meme stock or whatever, right? And etc. But I think what people misunderstand is that's not the norm, right? And the most important thing, and I completely concur with what you're saying, Dimitri, is, and when I started out, I remember my finance professor used to say to me, he said, it's not about hitting home runs. You just want to constantly get on first base all the time. That's what you want to do. And that's really all about managing risk and hitting those, just getting on first base regularly, and the rest kind of takes care of itself. Because the real risk, when you have this kind of more speculative attitude where you say, hey, I've got $10,000 and I'm going to put $9,000 on AMC calls this week. Well, the reality is that it's likely you're going to get wiped out, right? So it's all about, developing building blocks, managing risk, and doing little by little. And then, your portfolio grows, you compound your gains, stuff like that. But, the speculative stuff, I think it is often driven by a misunderstanding on how capital markets work and how risk works. We always think about what we can earn, or the profits we can make, rather than what we can lose. And we should really be doing the opposite, which is saying, hey, I put this trade on, and I've put this trade on as we speak, this XLE position, I can lose $10,000, and I'm fully cognizant of that. So completely agree.
Right. You have to always be thinking about both sides of the trade, not only what I could potentially make, maybe even more important, what can I potentially lose, and is that worth the risk? And can I live with that? Because you have to then live to make another trade. You have to, you can't put yourself out of business on a single trade. That's kind of crazy, right? So you never want to put yourself out of business on a single trade or an idea, so I think that's important. And a lot of newbies, I think somehow that doesn't click.
Yeah,
I think farmers came up with the saying, all your eggs in one basket was a,
yeah. That basically is, Markowitz's modern portfolio theory, right? He did it with some fancy graphs and stuff, and then you had the Chicago School and all these economists doing all this fancy stuff. But these farmers said, all your eggs in one basket. It's kind of the same thing. So, yeah, that's it. So look, that's pretty much, we've got those positions filled. So I'm long now. You can see it here, 2,000 shares of XLE, and I've got my protective puts protecting that position, and we're going to let that run for, I would say, the better part of 6 months, and we're going to manage that. I'll probably sell calls against it or whatever, and we'll just see how we go. I'm pretty confident we should do okay. The other ones haven't been filled, but I'm sure they'll get filled a little later on today. Let's just probably finish up here very quickly. And this is what Dimitri mentioned before, right? So 10%, if you wanted to put this position on, or anyone wanted to put this position on, you're going to risk $10,000. You need to have $500,000 in your account. So for sure, it's not for everybody. But you can actually manage this and do $1,000 instead or whatever. But you always need to look at max 2% loss on any one position in your portfolio. Now, the break even for this position is going to be my $10,000, so my $137,000 or thereabouts what I paid, plus the 10,000 divided by, now I sold, this is incorrect, I bought 2,000 shares, but we'll have an average number there, which we've got to get over before we start making a profit. And we can see that, we can see that there. That's the cost, the cash outflow for us. We just spent $10,000 buying puts. But what you can see on the diagram now is, so normally with an equity diagram, it'd be like this, and we could go to zero. Well, here it's not the case, right? Because once we get down to this level, I can actually use my puts to protect the downside on the position. So yeah, that's pretty much it. I think I've outlasted my time.
well, the time does stretch a little bit during these webinars. It was a great job, Jake. For those who don't know, Jake will be doing this every 2 weeks. I think Jake will look at this.
Yeah, thereabouts. Yeah.
Yep. We did have one question. Well, we had a couple questions,
cool.
But those basically could be answered on the pre-market show. But Aggie was asking, how do you see the Greek on the TW? You mentioned the TWS system. I don't think you're using the TWS system. You're actually using IBKR system, correct?
Yeah. So TWS is Trading Workstation, which is the Interactive Brokers workstation.
Oh, gotcha.
I actually use them more on, I actually look at them more on MarketChameleon, which is kind of crazy. Well, it's not crazy, but because I'm on MarketChameleon all the time to identify positions. What you can do is you can set it up here, right? So when you actually set up a position, you can actually change these columns by right-clicking, and then you can actually configure that column there, and you can put deltas in. And it's very important that you do that, and then you can see what your deltas are like, and approximately how the position is going to behave and roughly the probability of whether it will expire in the money or out of the money as well.
Perfect. Great job. We did have a question, D. I'll send it to our email. Someone's asking, how do you screen for options that may be an opportunity to buy on MarketChameleon? That's something maybe we can do next week on our pre-market show. We do have a live pre-market show every morning during the trading week at 9 a.m. on YouTube Live. Correct, D? Don't we do that every morning?
Yeah. And I think we're actually, I'm going to do something with Interactive Brokers. We're going to do a webinar with, on Interactive Brokers, and that's going to be screening call options.
Awesome.
Screening call options, potential buying opportunities.
And that is the second Tuesday of the month, right? So the next Tuesday is the 13th.
Yeah. So I think that's when we're going to do it. So we'll go through an example.
Yep. And that's on the Interactive Brokers website right now. If you want to mark it, if you go to their webinar functionality on the Interactive Brokers website, you'll find Dimitri's presentation is set up for the 13th. Great job, Jake. Everyone loved it. Thank you so much, buddy.
Jake, thank you so much. Really appreciate
you guys.
Coming on.
See you on the Discord.
All right. Have a great weekend and holiday in the United States. Everyone else around the world, you have a safe, happy weekend. Bye, D. Bye, Jake.
Thank you.
Bye.